Hello friends, welcome to the YouTube channel of FinSim. My name is Raghu, a certified financial planner and founder of FinSim. Through these educational videos, we are trying to simplify the complicated world of personal finance for you. In this video, we are going to discuss about the new marketing technique used by the telemarketing teams for selling life insurance products. Before we proceed further, a quick disclaimer. This is strictly for education purpose. Any company names we might mention is for reference purpose only. Please consult your financial planner before proceeding with any purchase. Views expressed in this video are based on our personal experience and analysis. Similar to most of you, I'm also a victim of telemarketing calls. Even though my number is registered under the D&D list, that doesn't stop telemarketing teams from calling me anytime. General rule of telemarketing is to grab the attention of the prospective clients within the first 10 to 15 seconds. This is where you will be asked with a question which will raise your interest level. It goes on like this. Would you be interested in investing in a life insurance product which will give you a guaranteed 12% return? Who would not be interested in investing in such a product giving a guaranteed 12% return, wherein the bank FDs and other fixed income products are delivering anywhere between 5.5 to 6%? Your obvious answer would be yes. Telemarketing individual will now proceed to explain how 12% is being calculated. To explain this in detail, they will generate a sample insurance quote. I won't take the product name here as this technique is used to sell insurance products of different companies. Policy period will be of 10 years and premium is 1 lakh rupees per year for a life cover of 8,52,493. However, as per the telemarketing team, investor need not pay the premium for 10 years and he needs to pay only for 4 years. After 4 years, investor need to place a request for surrendering the policy. Upon surrendering the policy, investor would get a total of 5.35 lakhs, which would comprise of paid up value of 3.41 lakh and surrender value of 1.94 lakh. The next stage is where they make an amazing effort to prove their claim by taking you through the official policy document. You will be asked to open the policy terms and conditions from the official company website, and you will be directed to the section where it is explained how the paid up value has been calculated. Formula for calculating the paid up value is basic sum assured divided by total number of premiums to be paid multiplied by total number of premiums paid by the insured. In this case, 8.52 lakh rupees would be divided by 10 years, which is the total policy duration, multiplied by 4 years, which is the premiums paid by the insured, would result in a paid up value of around 3.41 lakh. Next, you will be guided to look at the illustration of the policy already sent to you and will explain that after 4 years, this policy would provide a guaranteed surrender value of 1.94 lakhs. After summing up both these amounts from paid up value and surrender value, you would receive a sum of 5.35 lakh. And if you were to calculate the internal rate of return with these cash flows, you would see 12% as a rate of return. This is such a brilliant effort from the telemarketing team to prove that their product delivers what was promised in the initial sales pitch. If a person is not aware of how insurance work, he or she would definitely be convinced with this policy and would be considering buying this policy. However, being a certified financial planner, I knew what is wrong and this video is an attempt to explain the same. Let's now make an attempt to understand the basics. What is the definition of a paid up policy? There might be certain situations where the insured has paid two or more premiums. However, insured is not in a position to pay the remaining premiums. Insured in that case can request the insurance company to convert this policy into a paid up policy, or even if the insured doesn't notify the company and fails to make future payments, insurance company will automatically convert this into a paid up policy. When the insurance policy is converted into a paid up policy, basic sum assured gets reduced with the formula of paid up sum assured equals to basic sum assured multiplied by number of premiums paid divided by total number of premiums. If I have to take an example in order to explain further, if the basic sum assured is rupees 10 lakh and total number of premiums to be paid is 10, but insured has paid only 4 premiums, then the paid up sum assured will be 4 lakh rupees. In addition to the paid up sum assured, loyalty bonus, which would have been accrued till the paid up date, will be paid in full at the time of policy maturity, and also loyalty bonus after the paid up date is paid on a pro rata basis based on the paid up sum assured. These amounts are paid after the policy tenure is completed and not in the year of discontinuation or surrender, as explained by the telemarketing individuals, which is completely a false claim. Now, if we were to calculate the IRR, it works out to be a meager 4.73%, which in simple terms means this policy is failing to beat even the inflation rate and other assured fixed income returns. Now, let's look at what is surrender value. Most of the policies acquire some amount of surrender value after payment of true premiums. Surrender value varies for each insurance policy. In this policy, if the insured were to surrender the policy after 4 years, guaranteed surrender value would be 1.94 lakh. IRR in this case would be a negative 26.9%, which in simple term means we are going to be losing significant portion of the premiums paid by the insured. Conclusion: it's either the paid up value which is paid on maturity or surrender value if the insured chooses to surrender the policy, and both are not paid together. A clear case of misrepresentation of facts by the telemarketing individual. Never club insurance and investment together. It won't be a great value proposition. For all the insurance products which you purchase, there is a free lookup period. Please go through the policy document to confirm if what the insurance agent explained matches with the policy document. If not, please proceed to return the policy at the nearest insurance company branch. If you pay one premium and do not return it during the free lookup period, you will find it very hard to convince yourself that you are going to be losing a significant portion of the premium paid, and you will end up continuing to pay premiums for such policies till maturity. Let me tell you, with experience after assisting about 110 odd families, we have seen quite a lot of such instances. Finally, please be cautious about such telemarketing calls and do not fall prey to such mis-selling. It's always better to shout when in doubt. Seeking an expert opinion before subscribing for any such policy would be a wise choice to make. We would be more than happy to help you in making the right choice without any obligation to purchase from us. Remember, we are just an email or a call away. Hope you found this useful. If yes, please do share it with your friends and family. Please do reach out to us for a free consultation on how you can achieve your financial goals.